What is going on, everybody? This is S Trades, and this is day 18 of the bootcamp. And in this video, we're going to be going over risk management, which is probably, in my opinion, one of the most important things after psychology. So without further ado, let's get straight into the video. Risk management is one of those topics that needs to be discussed very thoroughly, and it's pretty much going to be that one other thing other than psychology that is going to pretty much make you profitable or not. Because risk management, again, if you don't have good risk management, you can have the best 99% winning strategy and you can have the best psychology ever and you could be like trading like a robot. But if you don't have correct risk management and the risk parameters in place, you'll never be successful. You're never going to get a single dollar from the markets, because as you know, as day traders, we are risk takers, right? We take on risk, and you have to kind of manage your risks, not what kind of sizing to put down. You need a certain rule book that kind of guides your risk parameters to tell you, like, okay, if this trade is really good, you have a lot of conviction, you can go on full size. And then there's maybe like a little mid setup or some setup that you might not be too sure of, then you kind of size down, right? Or you just don't take the trade at all, right? So these things, right? And just in general, kind of like calculating how much are you risking, right? How much are you willing to lose and how much are you willing to get, how to calculate that, how much dollar amounts and things like that. So all of that is going to be discussed in this video, so let's get straight into the point. So without going into the technicals first, the first two things that I want to talk about is having specific rules for risk parameters, right? If you don't have rules set for your risk, then you're gambling. Like, it's as easy as that sounds. Like, if you don't have any risk measures to tell you like how much trades are you going to take, what kind of sizing are you going to go in, how much are you willing to lose, and things like that, it's at that point it's just pretty much gambling, because you're putting on random size and then you're putting your stop loss at a random point where it's like, okay, I don't want to lose, let's say $500 or $400, and then it's like at a very bad spot for a stop loss, but you just put it there because you don't want to lose that amount. So that's, again, that's not trading, right? So first rule that everyone should have is how many trades a day they should take, right? So the way I go about it, and the way that I'm trying to go on about it, right, and the way pretty much most of the professional traders go about it, is they take 1 to 2 trades a day max for the day, right? If you're a day trader, 1 to 2 trades a day at max, that's all you need, right? You don't need to go any more than that, because at that point, you know, your psychology, you have a certain capacity towards where you could take important decisions throughout your day, especially when it comes to be revolved around money, right? Which is why if you see a lot of like actual gamblers in the casino, right, the more they stay in the casino, the more likely chances that they're going to be losing, because, as you know, there's a straight up correlation, right? The longer you stay in the casino, the more money you're willing to lose, right? Same thing with trading, right? The more you're staring at the charts, the more you're trading, the less likely your decisions are going to be like used with the actual brain and not with like emotions. So the first rule that everyone should have is to set how many trades a day you're going to take, right? I recommend 1 to 2 trades a day maximum, right? Like, now, if you're going to be following along with the rules that I give you, right? So you take 1 to 2 trades a day, right? If, let's say, your first trade is a winner, right? So let's say you enter a trade, right, and you get, I don't know, $500, $600, whatever, however much money you got, right? If you win on that trade, you are done for the day, right? You close the charts, you go on about doing whatever other things you got going on in your day. You go to work, you go to your job, you go work out, I don't know, walk, meditate, whatever you got going on in your life, you go and do it, right? You just close the charts. Trust me, this is going to save lots and lots of money, because lots of the times I went through it, and I still go through it sometimes, where, you know, I'll take a winning trade, right, and then that might not be like a satisfactory amount for myself, right? Like, I won $600, like, oh no, I won $1,000, right? And then I sit there in the market. The more I stare at the screen, your brain is going to be kind of making up scenarios in your head, telling yourself like, okay, well, this trade right here looks good, you could possibly make $400, right? And then you take that trade and you lose. Now you go back to break even, right? You had $600 up in your P&L, now you're at break even, right? And then now your mind is telling you, okay, I just need to get my money back, right? Like, I just need to get my money back and I'll be done for the day. And then you go take another trade, you lose that trade. Now you went from being up on the day to break even to not being red on the day, and at that point you're done. Like, trust me, like, your psychology, your capacity of your emotions is gone to the roof, right? At that point, you're just going to be gambling. You want to, you know, at that point you're going to be so desperate to the point where you just want to go back to break even, right? I know I sound very similar to a lot of you guys, and I know it sounds very, very familiar, right, with a lot of the cases that you guys might be going through, right? So At that point, you'll just want to be going break even, and then you take another trade, you go into more of that rabbit hole of a loss, and then you realize that you've now taken 6, 7, 8, or however many trades, and now your account is blown, right? So now you went from being up on the day to break even to a loss to now a blown account. You see what I'm saying? Like, so keep it strictly to 1 to 2 trades a day, right? So if you take your first trade, it's a win, you get off, right? You're done for the day. However, if you take your first trade and you lose, right? Let's say you lose 400 or 500, whatever, however much the amount would be, right? You lose that, and then you have one more chance on the day to, take another trade. But the only thing is, you're gonna have to risk in half, right? So speaking, let's say on NQ, because that's what everyone, majority of the people trade. So let's say you're trading NQ, and let's just say you're trading 2 contracts, right? You're trading 2 contracts. Boom, you lost, right? Again, 2 contracts is pretty a lot. Like, it's a big size, right, for Nasdaq. But let's just say for this scenario, right, you take a trade, right, with 2 cons, and then you lose, right? The next trade, you could take it with 1 or even micros, right? You could go scale down to micros, right, and trade with that, because now you have to size down, right? Even if you lose that trade, it won't be as significant because you size down, right? And then you could potentially make some money back, right, or even be at a break even, or even be at a green of the day, depending on what kind of trade you do, right? So first trade of the day, you win, you get out, done for the day. If you lose, you can have a second trade, but that second trade has to be half size, right? Okay, we got that out of the way. Those are the 2 rules that you guys should follow, and I highly encourage everyone to have these specific 2 rules, right? You could have other rules in terms of like the entry models, depending on your strategy or whatever other rules you got going on. But in terms of risk parameters, these are the 2 rules that I guarantee that everyone should have, and especially professional traders. Like, you can ask anybody, they will all tell you the same thing, right? Trading should be boring. Trading shouldn't be an exciting feeling. You shouldn't be feeling this like adrenaline rush. You're having sweaty hands, your heart is racing, right? You're getting that dopamine kicking in, you want to trade, you're itching to take a trade. That is straight up gambling. That's the feelings that you get when you gamble. That's when you go to the casino. That's the feelings that you get, right? If you want to be a professional trader, right, you can't have those feelings play around with you. You can't be trading with those emotions. If you see any of the professional actual day traders that make actual money and don't just sell you a course or live this fake lifestyle, it's a very, very boring process, right? They sit there at the screen, they could be staring at this chart all morning or however long they sit on the charts and not take anything for a day, 2, or even a whole week, right? They're not going to take anything because no setup is presenting themselves, right? They're not going to force anything just because a stock is dumping or pumping, right? They're not going to be falling into that because they have specific rules in place, and if you're not following your rules, you're not going to be anywhere near successful in this field, right? So moving past these 2 rules, right, now let's talk about the actual technicals, right? First video that I ever made, pretty much going over the basics. You guys could go over and then watch that video. I'll give a link somewhere over here on the screen, maybe top right, I believe. And just pretty much talks about the margin and how much money you would need to hold the position and things like that. So we're kind of going to go back to it for just a brief moment, just to kind of analyze how to pretty much calculate risk, right? So let's take a look at this chart, right? So let's say specifically at this moment over here, you want to take a short, right? It doesn't matter what kind of strategy, just for this purpose in the scenario, let's just say you want to take a short position over here, right? Now, a logical stop loss, right, in this kind of area would be the swing high, right? Maybe a little above the swing high. And then let's just say you're just, nothing too crazy, you're just targeting this low, right? So now, when you see your chart like this, right, you see there's a number on the stop and then there's a number on the target, right? I see this a lot where people talk about risk management. No one really actually talks about how to go on about calculating the risks. Obviously, the brokers and whoever you're trading with is gonna kind of automatically do that once you enter a trade, and then you'll be able to move your stop loss and your take profit and then see how much you're gonna lose. But you don't want to do that after you enter a trade, because you need to know how much size you have to put on for a specific trade. Let's say I'm have very high conviction in this trade and I'm very confident. Let's say this is like my A+ setup. I'm just super confident that we're gonna go over here to the swing low, right? Then I can go in full size, right? So let's say it's 1 contract. Let's say just go for this scenario. Let's just say that my full size is 1 contract on NQ, right? So now, again, the way to calculate your stop, how much are you willing to lose and how much are you going to be getting, right, is by looking at these numbers over here, right? This is a must right before you enter a trade. You cannot just enter a trade randomly hoping that your stop loss is going to be around $400, $500, or however much you're willing to lose, right? And another thing is your stop loss, right? When you enter a trade, think of it as your stop loss is what you're paying to enter that trade. So let's just say this stop loss would be equivalent to like $600, right? Because it's 34 points. I'll explain that later. But let's just say that this stop loss would be around $600, right? So in your head, you should be thinking that you're paying $600 to enter this trade because in your head you lost the trade, right? And I know it sounds very dumb to think it like that, but you're gonna, in your head, you have to be willing to lose that amount. So you won't be emotional. You won't try to move your stops like lower or something, or exit early because you're too emotional. You're afraid of losing that amount, right? So let's just say again, $600 for this loss, right? You should be comfortable with that loss, right? If you're not, then you have to scale down, right? So let's say you're comfortable with only losing $300, right? So then you have to adjust accordingly with your contract. So if you're only comfortable with trading and losing $300, right? So you won't be too emotional, then size down to a certain amount that would allow your stop to be $300, right? So now how would you actually go on about calculating this, right? So again, looking at these two numbers, right, your stop and your target, it tells you how much points away your stop and your target is from your entry, right? So if, let's say if you entered over here somewhere, right, the stop over here will be 32.75 points, right? So now, like I said, if you enter with one full NQ contract, right, just by looking at this, right, $1 movement, right? So look right here, every time Nasdaq goes from like say 22,930 to 22,928, 29, that's a $1 move down, right? So because you're shorting, so now you're going to be getting $20 per point, right? So again, value per point, meaning every time Nasdaq goes up or down $1 or 1 point, you'll be getting $20, right? So if you enter this trade with one Nasdaq contract, right, so now every dollar would be $20. Now how would you calculate the stop, right? What you would do is you pretty much multiply $20 by the amount of like the number that you have on your stop, right? So in this case, let's just round it to 33, right, because it's 32.75. so you would do 33 times 20, and that would be 660, right? So this is the amount that your stop loss would be at, right? So if you enter this trade at this specific point and you set your stop over here, you would be willing to lose $660, right? Now looking at your target, it's 47.50 point, right? So let's just round it up to 48. Now it would be $960, right? So you're risking 660 to make 960, right? You guys see the gist? So this is how you're going about calculating your risk, right? Now let's just say that 33 points, right, which would be your stop, which is $660, is not what you're comfortable with. Let's just say that you are in your actual live or funded account and you want to risk less, right? This is where you would head down to micros, right? Instead of being a full mini contract, you would scale down to micros. And in this case, how would you calculate that? So if you guys don't know, 10 micros on Nasdaq would be equivalent to one full mini contract, right? So meaning one NQ contract equals 10 micros, right? So let's just say you want to enter a trade where you'll be risking around $300, right? So now that would mean that you would have to risk half of what you're risking on Nasdaq, right? So what would be half of Nasdaq? If the proportion is 10 to 1, it would be 5, right? So meaning on micros, you would have to enter 5 micro Nasdaq contracts, right? Not full on 10, because if you entered 10 micros, that would be equivalent to one full Nasdaq contract, right? So if you want to risk half of that, that would be 5 micros. And the way you would go on about calculating that is by looking at MNQ, right? So right here, I'm just guys giving you an actual visualization so you guys could see it. So in this case, it would be $2 per point, right? So you see how it's tenth of the actual Nasdaq, right? So for Nasdaq full E-mini, you get 20, and from micro E-mini Nasdaq, you get $2 per point, right? So now let's say you're entering 5 micro contracts, right? Now that would be $10 per point, right? Because you're entering 5 micros, right? And every point would be $1. So now every point that you move up or down, that would be equivalent to $10, right? Because again, half of 20 is 10, just logically thinking, right? Half of the Nasdaq would be 5, and half of 20 would be 10, right? That's just quick math, right? So $10 is what you would have as your micros. So now instead of calculating 33 times 20, you'll be doing 33 times 10, right? Because now you have half of the position of the full E-mini, right? You have 5 micros on it. So instead of risking 660, you would be risking 330, right? Same thing with the take profit, is 48 points, right? Instead of us having 960, you would have 480, right? You would have $480, right? So that's pretty much about how you go on about calculating your actual stop and your take profit, right? How much you're willing to risk and how much are you planning to get right out of the trade. This is very important. You have to do this before every single trade. I cannot emphasize this enough, because if you just randomly enter a trade with whatever amount of contracts, and then you'll be surprised, like, oh, right here, if I set my stop loss, it's like $1,500 stop loss, and I can't afford that, right? So then you start moving your stop loss over here, right, just so you could have like, $300 or $400 stop loss. That's not good, because it's not a very good placement of a stop loss, because it's like in the middle of nowhere, and price anytime could just come up right here, just rebalance this range and then come back down lower, right? So you wouldn't want to do that, right? So you'd always have to have a logical stop loss, right? You don't ever want to set your stop losses to like an emotional stop loss, right? So let's say you're not willing to risk this amount, so then you just put your stop loss over here, just you could risk very little. Well, you're gonna get stopped out, like you're gonna get stopped out, and then the trade's gonna end up kind of dumping back to your take profit, right? So never set emotional stop losses, always set a logical stop loss, right? So if your idea of this trade, for it to go down, where would you find like a logical point for it to like be no longer valid, right? So in this case, it would be this high, right? If price ends up kind of coming back up higher with a lot of displacement, we might most likely see prices go up high, right? So this would be a logical stop loss, and you have to adjust your risk accordingly, right? And now that we got that out of the way, you know how to calculate risk now. And now how would you go on about sizing different accounts, right? Because I know a lot of people trade funded accounts, right? Some people trade live accounts, and there's different approaches to different accounts, right? So the way I approach eval accounts, right, the funded accounts, I usually risk a lot heavier than what I would do on an actual funded, right? So let's say I buy like a Top Step evaluation account, right, and you need $3,000 to pass, right? I would usually try to risk pretty much like a lot of risk for me to make around 1,500 for one day, and then whatever the second day would be, also 1,500, so I could try to pass it in 2 days, right? Now this is a good approach only if you have a very decent strategy and if you have experience in the market, right? So I do not recommend this approach to new traders that don't know how to trade well, or they just started, because you could be very much over leveraging and you would end up blowing up accounts left and right. Okay, so do not do that if you're new. Don't do that if you never actually passed the funded account, or if this is your first eval account and you're trying to become profitable. Do not do it. Only do this approach if you have already passed multiple funded accounts, you know how it works, and you have an actual profitable system that brings you money and things like that. So in that case, I would risk a lot more on an eval, just to kind of get that process over with quickly, so you can get an actual funded account and then have your actual risk parameters in play, right? But you still have like your risk set like 1 to 2 trades a day, even on an eval, right? You only putting up trades that are A plus, like that are following all your rules, that 100% you have conviction on that trade, right? So those rules are still intact. It's just that your actual risk percentage would be a little bit higher on an eval compared to a funded, right? Again, only if you're experienced enough, right? Now once you actually get on a funded account, right, or have a personal live account, right, the usual like percentage, I would say, would be 0.5 to maximum 1% of your account that you'll be risking, right? Now this is a static risk management, right? It's a very static approach. You're not really changing it. You're kind of constantly having 0.5 to 1% risk for trade, which I'm not a big fan of, right? The reason being is because I like to be more dynamic in terms of my risk settings. So if, let's say, I have a very A plus setup, right, it's not that I'm gonna go on full ported, right, but I might put it like maybe 1.5% or something like that, right? Obviously nothing crazy, not like 50% of my account or full port that trade just because it's A plus. No, I still have my risk parameters in place, but I am willing to risk a little bit more because I'm so confident in that trade. I've seen that trade play out multiple times, right? So that is what's called dynamic risking, right? You're risking based on your conviction and based on a setup of the trade, right? So if you could have some sort of a checklist, for example, what I have down here on my bottom right, you see how I have a checklist? These are the 4 criteria that I have to see in order for the trade to be at least A or like B plus, right? These are the very least, right? And then comes my actual personal discretion towards the trades, right? And other rules that I have, right? But this is just the basic, the bare minimum for it to be considered at least B plus, right? So you should kind of have some sort of a checklist in your rule book, right? That, okay, if this happens, that happens, this is B plus, and then if this happens, then it's A plus, right? And then now I'm willing to really put on some size, and not like some size, but like I'm willing to risk a little bit heavier than usual. But then again, if it's just like a regular A or B plus setup, I would recommend, sticking to your 0.5 to 1% risk, right? Now again, I don't really like talking in percentages because that just kind of makes things complicated. You would have to go in and calculate things in a certain way, and it just really like not very efficient. So I'm going to be straightforward and give you an actual dollar amount, right? So, and even before I get to that, right, the reason why I say taking risks in terms of percentages is very like, dumb, especially on eval accounts, because what a lot of traders do, they calculate their risk based on the actual size of the account, not based on the drawdown that they have, right? So if you buy a $50,000 account, right, it's technically $50,000, right? But it's not really $50,000 because you have only $2,000 in your like account that you could lose, right? So technically, you're not really trading a 50K account. You're only trading an account that's worth $2,000, right? Because once price goes below, or if you lose more than $2,000, your account is gone, right? So people be like, oh, risk 0.5%, right? That's around $250 on an eval account. But realistically, that is not 5% of the actual eval account, because you only have $2,000 left in drawdown, right? You don't have $50,000. So realistically, 0.5% would be $10 realistically on your account, right? So that's why I don't like that approach. And then people be like, if you risk 1%, that would be 500. No, it wouldn't be 500 because you have drawdown worth of $2,000. Just because the account says $50,000 evaluation account does not mean that you have $50,000 left in leverage, right? Because yes, you're pretty much trading on a simulated like demo account, pretty much. You don't have $50,000 like to trade with, right? You only have $2,000 technically, right? So 1% on a 50K account would be $20, and that, you see how small that is, right? So that is why, again, I say that I don't really like going by the risks. Instead, I just go straight by the amount, right? So again, what do I mean by that? If you're on a 50K account, eval account, right, I would say if you're profitable, risk a lot. Like I, for example, risk like $800 like or $900 per trade, which is a lot. That's literally half the account, right? Because if I get 2 trades wrong, right, or maybe 3, my account is blown. But I only do that approach in my very A plus setups, right? And it works a lot of the times. I pass accounts in 2 days and I'm done with it. And I got over with it, and I just go straight to the funded account, and then I have my actual risk in place, right? So now let's say you are new, you don't have much experience, right? I would say keep it to anywhere from $200 to $400 to $500 max, right, in your eval. $500 should be the max amount that you should be losing on an eval account, because you have to give your rooms to lose pretty much, because now if you lose 4 trades, your account is gone, right? So even $500, that's like quote unquote 1%. That's still a lot, you could say, right, on an eval. But again, it's an eval, it's a simulated account. You kind of want to get it over with just so you can get on the actual funded account and possibly get paid, right? So now let's move on to the actual funded account, right? So now how would you actually go on about risking that account, right? So the way I do it, I risk significantly lower, right? I don't trade, and I don't even look at I don't look at mini Nasdaq at all. I go straight to the micros, and I would be trading like 4 to 5, like 4 to anywhere from 4 to 7 micros. Like 7 or even 8 sometimes would be the maximum amount of contracts that I would ever trade on a funded account, right? Usually it's like 5 micros, like half of whatever I just taught you guys on an actual mini, right? So let's just say again, I enter this short right here, right? My stop would be over here, and then take profit will be over here. And simply by just looking at this, right, how would you tell how much you're going to be risking if you're on a funded account? Let's just say I'm willing to only lose like $200, $250 max, right? This would be perfect for a 5 micro trade, because 5 micros would be $10 per point, right? So $10, 10 times 23 would be 230. So now that means if I enter a short over here, my stop loss would be $230, which is perfectly fine with me, right? And then I'm risking 230 to pretty much make 570, right? Because 10 times 57 is 570. So now it's a perfect way, like 1 to 2.5 risk to reward ratio, right? So it's very, very good, right? And it's pretty good risk, because you only lose, risking a good amount, right? Because you don't want to risk something like, I don't know, like this, right? $700 worth of risk, right? Because you get 2-3 trades wrong, your funded account is gone, right? Now you want to give some space for yourself to make your mistakes, because again, you're not gonna go on about and just win 5 trades all in a row and then boom, you get your funded, you get your payout, right? That's not gonna happen. Sometimes it could happen, right? You can get lucky, you get 5 straight winning days and then boom, you get a payout. But most of the time you're gonna lose, you're gonna slip up, might do mistake here and there, right? You want to give yourself some room to play around with. Like if you lose today's trade, if you lose tomorrow's trade, you don't want to be in your funded account or your personal account so worried that, okay, if I take the next 2 trades, my account is gone. That is gambling. Like you don't want to be in that position, right? You want to give your room at least some space to lose. So if you're risking $200 per trade, you would need to lose 20 trades. You would need to lose 20 trades in order for you to blow the account. How likely is that? That is very, very unlikely for you to go on a 20 losing day streak, like unless you're just over leveraging. If you're just revenge trading, taking some random trades, right? Then yeah, sure, that could happen. You could lose 20 trades in a row. But if you're following your system, if you're following your rules, 20 losing trades, that's very unlikely, right? So that's what I'm talking about. You need to give yourself some room to play with, okay? In your head, you'd be like, all right, in order for me to lose this account, I have to lose 28 plus setups, which again, never works like that. Like it doesn't happen if you have a profitable system. Like for example, my system has a 70% win rate. What does that mean? 70% of the time I win, 30% of the time I lose, right? I will very, very unlikely lose 20 trades in a row, or even 10 or even 5 trades in a row. Like that is something that would not happen. And like I could lose 1, 2, or 3 times maximum. I would lose 4 days in a row. Like that would the max be in terms of my strategy, right? I don't know how your strategy goes. That I don't know how you're risking, how you're playing, right? Because some people think that you need to have at least 50% win rate in order for you to be profitable. That's not true at all. You could have 40%, even 30% win rate strategy and still be profitable. You might ask, oh, how's that possible, right? Because again, it all matters with your RR, right? Risk to reward, right? So let's say if you're risking anywhere to like 20 points and then you're targeting like 150 points, right? Sure, your strategy could have 30% win. Let's say 30% of the time you can only win and 70% of the time you're losing, right? Let's say every time you're hitting stop losses, it's only around 20 points, right? And then when you hit your actual target, right, it's like around 130 points, right? That's like 1 to 5 risk to, like 1 to almost 6 risk to reward ratio, right? Like that's what I'm trying to tell you guys. In trading, you don't have to have 100% win rate, right? Like you could either choose, do you want to have high risk to reward, or do you want to have high win rate, right? You can't really mix and match both, right? It's not really going to work like that. There's not much strategy. It's very unlikely for you to have a very, very good risk to reward and very good win rate. Like it's either one or the other, right? It kind of just depends on the person, right? If you are the person that likes to trade likes to hold their trades for longer and likes to catch these big trades, right, then you're most likely going to be trading something that's on maybe a lower win rate but very, very heavy in risk to reward, right? Meaning like you could be getting so much money when you win and very, very little money when you lose. You're going to be losing more often, but your winners are always going to be bigger than your losses, right? That is not the kind of person I am. I need to win a lot of the times in order for my psychology and for my emotions to be in place, because if I lose 70% of the time, I would be crashing out every single day, because in my head I need to be winning in order for me to be like kind of stable emotionally, you could say, right? So in my case, right, I like to have a high win rate percentage and just go for like 1 to 2. That's it. Like that's all I need, 1 to 2, or even 1 to 1, right? Like for example, even this right here, like this might be looking like a very like not so decent trade, right? It's 1 to 1 risk to reward ratio, right? You might be like, what is this? Like I don't like this trade. It's a very small. Like it doesn't really matter, because yeah, although you're risking 240 to make 240, right? Because again, let's say if you're taking 5 micros, you'd be 23 stop and then 24. If it's both 24 point stop and 24 point target, right? You're risking 240 and you're trying to make 240 all at the same time, right? Yeah, it might be like weird because you're only, you know, risking the same amount that you're gonna be making, but your win rate is high, right? So let's say, for example, your win rate is 70% or 80%, you're gonna be winning a lot more often, right? So let's say you enter over here, you win. Enter over here, you win, right? Enter over here, you win. And let's say over here you lose, but then over here you win, right? Across like a certain period of time, right? Over here you win. So now you're winning 70 or 80% of the time. Yes, you're losing 20% of the time, but you're, you know, although you're making the same amount of profit that you're going to be losing on your stop loss, it doesn't matter because you're risking, because you're winning a lot more often, right? So that's kind of compensating, right? I usually go 1 to 2, right? That's kind of the, you know, the sweet spot, I would call it, right? 1 to 2 risk to reward, right? Let's say over here, right? This is all I need, right? 1 to 2 right here, and it's perfect, right? So for example, I want to risk 1 to 2, let's say that right here would be 1 to 2 risk to reward, and then it also kind of goes along with this swing low. So I would potentially I would trail down my take profit to this internal low or even a little bit lower, right? Because I know a lot of times once price pushes past beyond certain highs and lows, then it kind of, you know, does a lot of momentum moves. So I might just kind of trail like my stop with me, right? And then, you know, have my target a little bit lower over here, but you guys get the point, right? Points of risk management. This will be a very long video because it's very important, and it's one of the most important concepts that you guys need to grasp other than psychology. Like, this is literally the two top things is your psychology and your risk management. Like, if you get those two things together, you are very likely to be making money out of the markets. But if not, if one or the other is missing, you're not getting anywhere. Okay, so again, another point that I forgot to mention about the dynamic trading, you should have a very clear, profitable system in place in order for you to be dynamically, you know, risking. Because if you don't have a, you know, profitable system, if you don't know what you're looking for, you can't be dynamically risking. At that point, yes, you go to only static, like only risk 0.5% to maximum 1%, right? Only risk that amount, right? If you don't have a profitable strategy and kind of get to know what your strategy looking like, or, you know, what do your trades look like. But if you already have a profitable system, if you already know what you look like, what you're looking for, you know, you should have, again, like I said, a checklist. You should have like a tier list of trades. Okay, so for example, this trade is A plus, this trade is B plus, this trade is B, and you shouldn't be taking anything less than a B. Like, once it's B and lower, then it's not really worth the risk in the market, right? Because why would you even risk for something like that, right? So you should be having a tier list, right? And should be only taking A to A plus trades, in my opinion. 1 to 2 trades a day, right? If you won your first trade, you're done for the day. If you lost your first trade, you have one more chance, and that trade would be half of the risk, and that's about it. Like, that is, again, your risk parameters. Very important concept. And if you guys didn't get anything or confused about something, comment down below, and that's about it. So that's about it for this video. Please like the video. Again, like I said, if you guys are confused about any of the concept that I said, comment down below and I'll be helping you guys out. So I will see you guys